Hello, international finance students. We are now in week 6, and we're quickly approaching the end of the course with only 2 weeks left. Good post this week with the kind of the changes in the historical changes, at least past 90-day of the currency. So it just kind of shows how important, especially large dollar contracts, about the question to hedge, because this, we could decide not to hedge and result in potential profit or potential losses. So most managers in the Treasury Department probably want to choose to hedge to avoid any potential losses. And as we said, that can be done with a variety of ways. It could be through a forward contract, it could be through options, it could be by borrowing the money and investing it. So all different possibilities. Well, for this week, what you need to do is you need to do your homework problems. You need to read chapters 12, 13, and 14, and then you will also have your second paper due. And I'm very flexible on the topics you want to do with this, whatever company you choose and whatever topic. So if you do have any questions, just email me, but that will be due at the end of the week. And then we'll have a brief forum discussion about how China is kind of opening up their markets to a degree in Shanghai, and I want you to give your opinions on that. Okay, well, for this week, a little bit about the topics. In our first chapter, chapter 12, we talked about the cost of capital, kind of questioning too whether, is it really cheaper? Is there a lower weighted average cost of capital when you're looking at going international? Are there opportunities there? And as you we'll read the chapter, there's still a lot of debate about the opinion. Some of this chapter should look familiar to you because it goes back to that concepts of what constitutes the cost of equity, the cost of debt, obviously the understanding of beta, your return versus the market return. But ultimately, it's more about, helping the multinational enterprise, the M&E, make decisions about which projects we take on. Is this meeting our investors' opportunity cost? Big difference between theory and what the real world actually does sometimes, but do we believe that this is going to add value when we take on this project? So that's kind of really the most important question, especially we're investing overseas somewhere internationally. Some other things, just kind of looked at this chapter too, talked about the efficiency of markets. They gave an example on page 335. Talked about, as you would try to access more capital, kind of a ranking, if you will, that I'm going to pick those projects that give me the highest possible return and continue to work my way down. And if I can get more access to capital and I think it's going to add value to the firm, I will. But again, it's there can be a lot of risk associated with going internationally for capital, and that's why it's kind of questioned too whether is it actually a lower opportunity cost if you go international. There can be that political risk, FF risk, a lot of different other things can happen. All right, a little bit about Chapter 13, this chapter was more about how does the multinational enterprise attract capital. You'll read about this in the different ways of the listing. What is the right capital structure? Should we be using debt, equity? And it also talked about the different types of securities. And probably you're going to have to work with some type of investment bank to go out and issue any new capital, be it equity or debt. It might be that you start off in the debt markets and move your way into equity markets as opportunities present themselves. So again, there's concerns again, with being international, but try to reduce those risks, listing on good exchanges and making sure that everybody's in agreement about repayment or how something will work out. The last chapter, chapter 14, dealt with tax strategies for multinational enterprise. This can deal for many things as a strategy to transfer pricing or working on foreign tax credit agreements. So when M&Es do make decisions about investing overseas, whether it's an actual physical plant they're establishing or doing business in that country, they do need to take into consideration the tax cost of doing such. So otherwise, can eat away a lot of those profits. Interestingly enough, in the United States, you kind of look at the book, we do have one of the highest corporate tax rates of anywhere in the world. And a lot of our U.S. companies actually just park their money overseas and they never bring it back. So it's kept the stock values high, but the United States is kind of missing out on potential millions and millions of dollars in tax revenues because of our current tax policy. That's another course and debate, but know that it does happen, and it is an issue for the United States right now. So, well, do email me if you have any questions, but otherwise, have a great week, and we'll talk to you online. Take care.